Hi, welcome to this video on general insurance concepts. My name is Chris, and I will be your insurance exam guide. So in this video, we're going to cover the concepts that are important for you to know for your exam, covering both life and health insurance concepts. So let's get started. To begin, let's start with talking about what insurance is. And the main way it's defined that you need to know in your exam is insurance is a way to handle risk. You'll hear us talk about the transfer of risk here in a moment. But what, to begin with, is risk? It's really just the potential for loss. So, in the case of life insurance, you're covering the potential loss of life. Obviously, with health insurance, you're covering the potential for your loss of health or for sickness and also prevention of sickness. It is also in property, the loss of property. We're not going to be covering property as much here today in this video series. We're going to be focused on life and health. So let's look at the next idea or concept, which is what are your options for handling risk? Here's the 5 ways in which you can handle risk: avoid, reduce, retain, transfer, or share or pool your risks, as it's called in insurance. So let's break these down one by one. The first one is avoiding risk. And sounds like a good idea, right? If we could avoid all risks, in effect, we wouldn't really need insurance. But we all know that's not a realistic possibility. Life itself inherently has risks. So the strategy of avoiding risks is a pretty limited strategy. Reducing risks is sensible, right? We all take precautions. For example, if we're driving, we try and drive at least in a reasonable way to try and avoid accidents. Same thing when it comes to our health or even our life itself. Everything that we can do to prevent illness or tragedy or death, we do that to the best of our ability. So you can see any effort that you take to reduce risk, the manner of taking precautions, is also a way of handling risks. Like avoiding it, though, reducing risk doesn't eliminate risk. Another way in which you can handle risk is to retain risk, is the term that's used in insurance, or self-insure. All that means is that you're going to take that risk in life or in health on your own. You're not going to utilize any other outside party to help you handle that risk. So, for example, if I decide to go without health insurance, then I'm self-insuring, meaning that I'm prepared or have to be prepared to pay 100% of the costs for any healthcare or health incidents that happen. So retaining risks, again, can be very costly for people. And that's why insurance is a useful product. It helps, so that we don't have to retain all of the risks ourselves. So finally, we get to the strategy that is the core or lifeblood of insurance, and that's called transferring risk. You need to know this on the test. You will see insurance referred to as the transfer of risk. What does it mean to transfer? Well, it means to turn over or give that risk over to an outside party. In this case, an insurance company. It is the safest option. The insurance company, in this case, when you transfer the risk, is going to cover at least a portion or even all of that risk that you have in your life. So again, going back to like a health insurance situation, we transfer that risk to the insurance company so that if I have some kind of catastrophic health event, I don't go bankrupt, right? If I have a $100,000 operation, I'm covered and I don't have to pay that $100,000 just on my own. So you'll see in health insurance, there's sort of a transfer of some of the risk and maybe retaining some of the risk. So it is possible with insurance for a person to retain some of the risk, but transferring those large costs or even the majority of it to the insurance company. In terms of life insurance, of course, we're transferring that risk of loss of life really entirely over to the insurance company, meaning that in the event of death, then the insurance company pays a set amount, whatever was decided on in that policy. So the risk associated with loss of life then is transferred to the insurance company, and they're going to pay out to the beneficiaries or the people who are receiving the benefit of that policy. Another option for handling risk is called sharing that risk or pooling the risk. So this often happens within a group or organization. Let's say, for example, that you run a small business and there are other people, other small business owners with a similar kind of risk, and you pool together your resources and create a way of protecting each other from those risks. In other words, you put your own money together within a large group to create a pool of money that's available then for anyone in that group to utilize if some sort of incident occurs that they need the coverage for. Another example of this would be there are some church organizations who offer to those church members to pool their money together to form a kind of policy to cover their health. It's not exactly insurance, it's a, a share of money that's put together. And there are rules and regulations that are set up around that, but it's not officially an insurance policy or an insurance company that's handling that risk. So again, you get the idea. Risk is about spreading that risk. Handling risk is about spreading the risk beyond just yourself, so that you're not responsible for 100% of the costs yourself. And that's the main takeaway here when you talk about handling risk. How do we manage that in a way that's not going to leave us as an individual to end up bankrupt. Okay, the next concept we're going to address here are called hazards in insurance. And hazards, another way of saying conditions where there's an increased chance of loss. And of course, it's important to start thinking in a sense from both the standpoint of us as regular consumers or individuals, and also learn to think from the standpoint of insurance companies who are taking on risks. So that's one way I'm going to have you expand your thinking to include what's the perspective of insurance companies. And these hazards are really, considerations on the part of the insurance company that are going to make for conditions that make it more likely for a person to experience a loss. And so, of course, those are very important to insurance companies to manage so that they don't have to pay out too much on any one member of their policy. So let's break these down and look at each one of them individually. So the first one is physical hazards, and that's pretty self-explanatory. If you were going to sign up for a policy, and let's say it's a health policy, you have a chronic illness, or you suffer from obesity, blindness, or maybe you're a smoker, obviously those physical conditions are conditions which put you at a higher risk. So again, when we think from the standpoint of the insurance company, that's not good, right? It means they have a much higher chance of having to pay out on claims for people who have these physical hazards. So again, keep in mind these hazards are really looked at from the standpoint of the insurance company's perspective. Let's go on and take a look at the next type of hazard, and that is called moral hazard. So what's the risk here? Well, obviously, if somebody lies or conceals key information when they are filling out an application for insurance, or they're engaged in illicit behavior like doing drugs and alcohol, and covering that, doing things that are illegal. So people who are lying or doing illegal things, of course, are a much bigger risk. And the concept here is called moral hazard. So if you ever remember one thing, remember moral hazard is like lying and doing bad things. All right, so no morals, right? It's kind of contained in that word. Now, another very similar word, but different meaning, is morale. So what's the difference between moral and morale? Where we said moral is, not having any morals, lying and concealing things. Lack of morale means a person is careless or indifferent. And why is that a consideration for the insurance company? Well, somebody who's careless or indifferent is much more likely to engage in reckless behavior. They're not really concerned about outcomes. They're not really taking precautions. They're just, I don't know, either thrill seeking or have a come what may sort of attitude. And so that's a hazard for the insurance company that's taking on that risk. Right? Again, if you think from the insurance company standpoint, would you want to cover somebody who is planning on, going up and cliff diving, or, doesn't care when they drives really fast all the time, right? You would pause before you'd want to cover such an individual. So there you have it. Those are the three types of hazards. Just keep in mind, moral means, morals, and morale means lack of morale or carelessness, reckless, or indifferent attitude. Next concepts we're going to go to is loss, peril, and risk. So very straightforward here. Loss, like everybody understands intuitively, but from insurance standpoint, it's a more fancy definition, I guess you could say, is the unintentional decrease in value of an asset due to a peril. So it is a decrease in value. So remember, insurance is really about finances. Even life insurance, we think, with life insurance is covering somebody's life. It does, but it's doing so from an economic standpoint. So insurance is always concerned about, loss in economic value or decrease in value. So what's a peril? Because it says the decrease in value of an asset due to a peril. Well, peril in insurance terminology is the cause for the loss, right? So I guess the easiest example here actually comes from property insurance. We have hailstorms that happen, right? Or a storm that happens. That's a peril that could cause you to lose or have your house damaged, right? So that's one easy way of describing the peril. And risk is always that potential for loss. So perils are there, and they create, because of the reality of perils, those create the risks that we're covering through insurance. All right, a really important distinction here in insurance terminology is between speculative and pure risk. So you see in the picture there a roulette wheel, and that's speculation, right? And speculative risk is a situation where there's a possible loss or a gain. And insurance is not going to cover speculative risk for that reason. When you think about that, it makes kind of sense, right? Why would an insurance company cover some sort of gamble that a person is taking? Because they might lose, in which case the insurance company has to cover it, or they might gain, but guess what? The insurance company doesn't participate in that gain. So the easiest way to think about this stuff is, again, if you were an insurance company, would you write a policy for somebody to cover their gambling habit, where every time they lost, you had to pay them, but every time they gained, they got to keep the money? That's not a very good deal, right? So insurance companies do not cover speculative risk. So what do they cover? Well, they cover what's called a pure risk. And the definition of pure means that only loss can happen. So that's the only kind of insurable risk, is where loss is the only potential outcome. So what are some examples of that? Well, injury is one. There's no way that you can really gain from an injury, right? It's a pure loss. Illness is another one. We can't gain from the illness. We can only lose. We lose our health. And the big one, of course, is death. Death is a pure loss, right? There's no gain for that person. So these make, by by definition, these become insurable risks because there's no possible chance of gain. So the insurance company can decide, what's going to be the cost of that loss, and they can cover that potential loss, based on analyzing each situation. All right. So I know these are a lot of concepts, and the best thing to think of is you have to review these several times. So don't worry if it feels like a lot. It is. It'll all begin to sink in. You can watch this video multiple times. Let's talk about the elements of insurable risk. So there are some key things for a risk to make it insurable. Again, we're going to break down each one of those. So uh, bear with me. The loss has to be due to chance. It has to be definite and measurable. It has to be predictable, not catastrophic. It's got to be large in number or common, and randomly selected. So some easy terms in there, some maybe slightly confusing ones, but we're going to go through each one and make sure we break them down, they become clear. So first off is that the loss has to be due to chance. And that means that it was outside the control of an insured person. So this is really important. I guess, one of the things that you could use as an example, it's not a very happy example, but when it comes to life insurance, the loss of your life has to be due to chance. And you'll see actually clauses in every life insurance policy that says, almost everyone that says, it's not going to cover suicide, right? Suicide would be a way, that's in the control of the insured person. And so, death has to be due to chance. So again, when you think about all of these things, think from the standpoint of the insurance company itself. Why does it need to be by chance? Because if not, they can't make good statistics for outcomes that they can cover, right? It becomes not profitable for insurance companies to cover risks that are planned or events that are planned. They have to be happening by chance to make it work out statistically where it can still stay profitable for the insurance company. Loss also has to be definite and measurable. Same kind of thinking here. Insurers are only going to cover specifics, specific events that happen at a particular time and place and amount. It's not can't be something that's like vague. The loss has to be definite and measurable. So an example here would be maybe with a specific health event. If you had a heart attack or some severe uh, thing that happened, some sort of loss that happened, um, it has to be very clear when and how that happened, so that the insurance company can cover it. It also has to be predictable. Insurers have to be able to use statistics to define the average, what's called frequency or severity of that loss. So insurance companies are always analyzing statistics. So it's these are mathematical kind of calculations. If they couldn't do that, they couldn't run a business. An insurance company can't exist without being able to calculate statistically how many losses it's going to incur. I, Again, think about it. If you were setting up an insurance company and you had no idea, how many losses that might occur, and you're taking in people's money, right? Premiums they pay for that policy, and you have no idea, how much you're going to have to spend out. That's not a sustainable business model, right? So for insurance to work, for the companies and then for us as the people who benefit from the insurance, losses have to be predictable. They have to be able to do an analysis. Maybe another, example from property insurance standpoint would be, they're going to look at an area in which you live and determine how many risks, how often, for example, hailstorms happen in your area, or how often do hurricanes happen in your area. And they can look at that statistically, right, and make decisions about how and if they're going to cover those risks. So predictable. Also, the loss must be not catastrophic. Now, I've just used an example of like hurricanes, that sounds pretty catastrophic, right? So uh, the insurance company has to have a way of dealing with catastrophe. Well, again, remember, we're thinking from the insurance company perspective here. What does catastrophe mean to an insurance company? Well, it really means what if there's too many claims at once? Uh, so using the hurricane example or flooding example, right? If you're an insurance company that's covering people for flooding in an area like where Katrina hit or covering for hurricanes in Florida, you're at risk for having to cover catastrophic amount of claims all at once. So insurance companies have two options in that situation. They can either decide not to cover at all, so they can exclude coverage, and you'll see that sometimes like with flood insurance, or in a health insurance example, you might have a policy or a life insurance policy that won't cover people if they're, diabetic, for example. So, they're going to maybe exclude certain uh, things that they cover. That's one way of not having too many losses at once. The other option that they have, and you take note of this one too, is to use what's called reinsurance. And reinsurance simply means the insurance company buying an insurance policy. That sounds kind of different, doesn't it? Reinsurance is an insurance company taking out a policy for itself to cover in the case that it has a situation like that. Again, a good example is a hurricane, use some sort of huge event that's going to cause a lot of claims and literally could make that insurance company go bankrupt if they weren't covered. So they buy their own policy from another insurance company that covers them. So it's almost like two layers of coverage, right? So reinsurance is the insurance company transferring risk to another insurance company to protect them from catastrophic situations or situations where there's, a huge amount of claims all at once. Okay, the next element here is the loss has to be large in number or common. And this is an important concept for you to know. You will see this, for sure uh, on the exam. There is called the law of large numbers. So make a note of that. The law of large numbers. There have to be enough things in common with the insured to make a big enough pool of what are called homogeneous exposure units. I know that's not language you see every day, right? It simply means people with similar risks. Here's an example. Let's take a life insurance example. When you look at any given age group, let's say a 30-year-old male or a 30-year-old female, you can look at statistics, right, and see what's the chances of them, you know, uh, for them to lose their life. And there are similar statistics. And if you have enough of them that you're covering, then that large number makes it possible for you to predict for those statistics to work out. So let's take an example. Let's say I'm writing, again, I'm an insurance company. I started an insurance company and I decide to cover, people for life insurance. And what happens if I only signed up like 10 people? I only have 10 people in my insurance plan. That's not a very large number. So I might have all the statistics for where they live and what age they are to predict, how many people that age are likely to die prematurely, at age 30. But if I only have 10 people, who knows, right? I might get really unlucky, and four of my 10 people who are members of my insurance company um, die all within the same year. Now I've got a very high claim, to pay out. So statistically, the way statistics work is unless I have a large number of people, it's really hard to make those numbers work out in a way that I can predict and I can manage. So here's what you need to take away. The larger the group, the more predictable losses will be. And that's just a rule of statistics. If I have 1,000 people in my plan, or even 10,000 people in my plan, across 10,000 people, those statistics are going to end up working out pretty right on. Like a certain percentage of those people will pass away, a very small percentage, right? Most people don't pass away at age 30. So once I have a large number, then I can manage that risk. It becomes an insurable risk. So that is the law of large numbers. Important for you to know. All right, now the last element of insurable risk is that the loss has to be randomly selected. That sounds like a kind of confusing or strange way of uh, describing, a risk, or a loss. But it simply means that in order for things to work out, again, to be predictable for the insurance company, they have to have a balanced number of good and poor risks. Let me give you an example from health insurance. Let's say, I sign up people for health insurance, and all of the people that I sign up, they're only people who are diabetic, right? Or let's say, 9 out of 10 of them have diabetes. That's not a balanced number of risks, right? Those people who have diabetes are at higher risk for needing health services and risk for other diseases. And as an insurance company, I'm liable for that. So if I have too many people with illness in my policy, and I don't have a balance, it's not balanced out with healthy people, then again, my business is not sustainable. Again, the best way to think about all of these concepts, these elements of insurable risk, is from that perspective of the insurance company. How can an insurance company stay in business? They have to have a balance, right? There has to be some predictability and balance in order for them to stay in business. So that's the element of insurable risk is loss has to be randomly selected. There's got to be this balance between good and poor risks. Speaking of managing risk, there is a concept called adverse selection. You kind of think of this as the opposite of what we just talked about in terms of random selection. Adverse selection is this tendency of people to seek out insurance when they're in a high risk situation. It's kind of natural when you think about it from the standpoint, of us as consumers. But when you think from the standpoint of an insurance company, that's not a good thing. For example, when is a person most likely to want dental insurance or to seek out dental insurance? Well, when their teeth start hurting. So that makes sense for us, right, as consumers. From the insurance company standpoint, that's terrible, right? What if all of your customers that are coming to you because they need to have an event covered, a health event covered right away? That can be very costly, right? Let's say, you have an insurance policy for dental insurance that costs, I don't know, $30 a month. And so the person pays their premium of $30 to have this policy, and they immediately go to the dentist in the first month to try and get a crown filled. That's $1,000, right? They paid $30, and they're going to need $1,000 of coverage right away, right? If you're an insurance company, That would be pretty tough if all of your customers were doing that, right? So it's adverse for insurers to cover this. Again, think from the standpoint of the insurance company with respect to these terms. It'll help you immensely. Adverse for the insurance company if people select insurance when they're at highest risk for needing it. Risk management is simply what insurance companies do, insurers do, to analyze risks and design ways to handle them. So they have to figure out, how do we offer this policy without people coming in that situation. We'll talk more about that later in other videos about some of the strategies, the plans, how insurance companies actually do that risk management in further sessions. And now we're ready to move on to insurance contracts. So, insurance is a business, and these contracts are legal contracts. So they have specific requirements to them, and you're responsible for knowing those on your exam. So there's got to be 4 elements in every insurance contract. Those are consideration, legal purpose, offer and acceptance, and competent parties. And you guessed it, we're going to break it down, cover each one of those individually. So let's start with consideration. So this term, consideration, means there's an exchange of value. Both parties, meaning the insurer, insurance company, and the insured, so that's us, right? Consumers or clients, people who are seeking insurance, both have to bring something to the table. That's true in every contract. That's not hard to remember. The insurer promises to pay covered loss that's defined in the policy, and the insured offers an application for a policy and premium payment. So you're going to know this, need to know this on the test. You're going to remember that consideration is an exchange of value, and remember what each party has to bring. It's really simple. The insurer promises to pay, and the insured offers an application, says, I want the policy, so that's part of their value, and then they make their premium payment as well for that policy. So that's consideration. Next concept there legally is legal purpose. So this is also kind of intuitive or common sense. The insurance contract can't violate any laws. So an example might be, you can't write a policy to cover a drug dealing business, right? Because the business itself is an illegal enterprise. So it might be, a great contract, a great concept, but it's not legal. Also, you can't write a life policy on a person without their consent. That's also not legal. For example, I can't just go, write a life policy on my father-in-law without him agreeing to it. Pretty obvious why, right? I might want to do that, capitalize on somebody's death. That's not legal, right? And they have to give consent. Yes, I will write a policy, and they agree to it, then it's fine. Not legal if they don't consent to it. So insurance contracts have to have a legal purpose. They have to be based on laws. They can't break any laws. All right, let's cover number 3 here, which is offer and acceptance. And I think this is pretty intuitive too. With any contract, there's usually some sort of offer, and then the other party has to accept. So the same is true in insurance. Let's use the example of a life insurance policy. An applicant submits an application. It usually includes their first premium payment. It's a way of showing, yep, I'm serious. I really want this policy. Then the insurer reviews that application, may go through a process of underwriting, meaning that insurer is going to take a look at that person's individual risks and decide if they want to take on that policy. So they can decide, yes, we're going to accept that person and accept their offer, and then a policy is written. Or they might possibly make a counteroffer and say, yes, we'll take you under these conditions. We'll get more into the details of what that might look like in a life insurance contract later on. For now, just suffice keep in mind that there's an offer that's made, the applicant makes the offer, and the insurer reviews and then decides whether they're going to accept that offer. Fourth, the insurance contract has to be made between competent parties. Again, I think this is pretty self-evident or intuitive, not hard to understand that anyone applying, if you accept an application as an agent from a person, you need to be sure that they're of legal age, of course, right? You can't have a child submit like a life insurance policy. And then, secondly, you have to also assure that they're of sound mind. This is particularly relevant. Let's say you're writing a life insurance policy for a senior citizen. Somebody maybe, I've written policies for people well into their 80s. Some of those folks are as sharp as a tack. Some of them you might feel like, yeah, I'm not sure if they quite understand what I'm saying. And anytime you're in that situation, it's best to, back away, not make a contract. Don't make a contract with somebody if they appear not to be of sound mind or really understanding fully what you're talking about because of their, mental capacity, whatever that might be. Another situation that diminishes mental capacity, if somebody's had a lot to drink, or maybe they seem like they're on pain pills or both, and they're very fuzzy and not clear about what you're saying, don't want to write an insurance contract in those sorts of situations for obvious reasons, right? So we only want to write insurance contracts when people appear of sound mind, they're competent, and they know what they're doing. All right, now we've got all that covered. Let's move on to insurance contract features. What are some of the features of contracts? First off, it's what's called a contract of adhesion. So I know these are new, unfamiliar terms. That's why we're learning them. But once you learn them, you realize they're not too hard once we break it down. Adhesion simply means that it is the insurance company who is the only author of that contract. So when it comes to insurance contract, you don't sit down together with the insurer and write it up. They write the contract. You, as the insured or the consumer, has to stick to it. That's how I remember it's called adhesion. You have to stick to what's written by the insurance company, and you get to either accept that or reject it. You say, yep, I want to sign up for that policy as it is, as it's written, or not. Um, Keep in mind that if there's anything unclear later on in the contract that you didn't understand, usually if there's any kind of legal dispute and you feel like you've been unfairly treated, courts tend to favor the insured in this situation for that very reason that the insurer or the insurance company was the one who wrote it. So if they wrote something that was confusing to you, it's not usually considered to be your fault if anyone who's reasonable could see, yeah, that looks kind of confusing. Then courts are going to rule in the favor of the insured in those situations if it ever comes to that. So all you got to remember here, contract of adhesion, it's the insurance company who writes it. The consumer has to stick to what the insurance company has written. All right. Next concept here is insurance contracts are what are called an aleatory contract. And I think that's an unusual term. We don't use that language in everyday life. And the way to remember it, it simply means it's an unequal exchange to cover the chance of loss. The best and easiest example here would be a life insurance policy. Let's say you make an offer for an life insurance policy. The insurance company accepts that offer, writes that policy. Now you're covered, and it's $100,000 death benefit, and you've made your first premium payment, which is $50 a month. You paid that premium, you're covered for that amount. And as fates would have it, let's say a terrible event happens and that causes you to lose your life, then that payment of $100,000 has to be paid to your beneficiaries. Aleatory means that was not an equal exchange, right? You've only paid $50 in that case, and the insurance company is on the hook to pay the full $100,000, even though they've only received 50. That's a pretty unequal exchange, but it's how it works. That's the whole idea, whole reason why people want insurance is that it is aleatory. So that's all you got to remember here. Aleatory means unequal exchange. Insurance companies pay, generally a lot more than what they receive from any one single person. So aleatory, you pay a little, you get a lot. And just to tie that back to what we said before, how can an insurance company do that? Remember that law of large numbers. They got $50 from you, but what if they sold 10,000 policies? Then they have enough to cover that death benefit for that one person, right? So it all works out with large numbers. That's how insurance works. All right, the next feature of insurance contracts is that they are what's called unilateral. And the easy way to remember this is uni means one and lateral means side. It's one-sided. Only the insurer is legally obligated to do anything. That sounds strange, right? But really, as a insured person, you are, if you want to keep a policy, of course, you have to keep paying the premium, but you can decide to stop paying the premium and just lose that policy. In other words, you're not under any legal obligation to do anything. Nobody says by law you have to pay that premium. If you don't, uh, you're not going to be able to keep the policy, but the insurance company can't sue you and say, hey, he didn't pay his premium. They're just going to cancel the policy, right? So it's only the insurer, only insurance company is legally obligated. What are they legally obligated to do? They have to pay you according to terms and conditions of that policy. So that's unilateral. It's one-sided. It's only the insurer who has a legal obligation. The next feature of an insurance contract is that it's a conditional contract. And that simply means that certain conditions have to be met for benefits to be paid. There's lots of different examples of this. You can think of any one of the conditions, for example, maybe you have a health policy. A health policy says, hey, we only cover you if you go to this particular network of doctors. If you go outside that network, we're not going to cover or pay for those health services outside of a network. So that's one of the conditions of the contract. With life insurance policies, there's other conditions that are going to be in any contract that have to be met in order for that obligation of payment to be fulfilled. Here's a concept that you also need to know, indemnity contracts. That simply, the term indemnity simply means restoring the insured after a loss, or we like to say, making somebody whole again. So you see in the picture, broken cup that's fixed. The indemnity contract restores you back to the original state you were in before an event happened, whether that's, a physical event, a health event, a life event, even property events. So indemnity contracts are not supposed to make you gain. And health insurance is a good example of that. Let's say, you have a health insurance policy and it covers you for, in many ways for your health events, illnesses or sicknesses that happen. Let's say, again, you had something like, a heart attack that landed you in the hospital. Well, they're going to pay for that hospitalization, but they're not going to give you additional money. So let's say your hospitalization, came to $20,000. Now, the policy says, they will cover an unlimited amount, or, they'll cover $50,000. But if your bill is only $20,000, they're going to cover that $20,000. You're not going to get an additional amount beyond that. So indemnity means that you're not gaining, you're being brought back to whole, meaning where you were financially before that event happened. Now, a value contract is something you'll see in life insurance. Those are value contracts. And that means that it is going to pay a stated amount for a loss. So when it comes to life insurance, you'll decide together with, with an agent, you're going to be an agent, you decide with your customer, what sort of value are they going to put on a person's life? Now, again, remember, when we say that, we're not talking about the actual value of that life. We're talking about the economic value of their life. So if a loss were occurred, that loss of life, how much money would be needed to cover expenses that are going to occur from that death, from that loss of life? So, for example, you would have funeral and burial expenses. Maybe you also want to cover current and or future expenses. It's not uncommon for somebody to want to have coverage to replace their income, for example, or maybe pay off the house or pay for their children's future expenses for education, for college. So you can calculate the value and then determine what's called a face amount. How much do I want uh, stated value for this person's life, and then you write a policy accordingly. Another feature of insurance contracts is they are based on what's called utmost good faith. That's just a fancy way of saying that it's implied or assumed that everyone is being honest in their part of the contract. In other words, the insurer is being straightforward as possible. They're trying to describe in good faith what they're covering, and the insured, the person who's applying for coverage, is being honest in stating, what their condition is. Again, whether it's life or health insurance, they're being honest about what's the condition of their health, what's their condition, their reality. Are there any risks that they're taking that the insurance company should know? So utmost good faith means everybody's, being honest and forthright as they enter into this contract. Now, another feature is called warranties, and these are statements made by an applicant that are guaranteed to be true. So they're not vague. They're very explicit things. Usually, they're straightforward example of that would be you write down your actual name, your date of birth. These are things that there's no ambiguity about, right? It's warranted, meaning it's guaranteed to be true. Another thing that's on a contract, though, are what are called representations. Now, these are different than warranties because they're still believed to be true, but they're not guaranteed necessarily. So, for example, maybe you as an insurance agent ask somebody about their health, and people, aren't necessarily lying or concealing and say, "Oh, yeah, I'm in good health," and they're not thinking very deeply about maybe what they've experienced in the past 2 years, 3 years. So, you might say to somebody, yeah, I'm healthy. You don't think back that actually a few years ago, you did have a heart attack. So maybe you're okay now, but the insurance company probably wants to know about that, because it's still can affect your health now, even though you're feeling pretty healthy. So another one, this actually happened to me recently. I had a client that said they didn't smoke because they vape. They're vaping. They're like in their mind, they're like, no, this isn't smoking. It's vaping. So they're representing, representation. They're representing themselves they're saying things that they believe to be true. They're not lying, but they're just not being thorough, necessarily. So representations are statements that people make that they believe to be true, but they're not warranted, not guaranteed. Now, on the opposite sense, or the opposite side of the spectrum, if somebody actually actively tries to hide something, obviously that's not good on any contract, right? And the concept here is called concealment. If you try and withhold or hide specific information, this is another thing that happened to me once. I was sitting with a client. I remember, I just remember this so clearly, sitting at their kitchen table, and there's an ashtray that looked just like that, just full of cigarettes. It came to smoking questions. So, I had to ask, do you smoke? Person looked right at me and says, no. And now they'd already told me they didn't live with anyone else. So uh, that's, pretty brazen concealment. You might even say, that's moral hazard, right? They might have just out and out were just lying to me. Or, who knows? I don't know. Maybe they have a neighbor that sits with them every day who does smoke that much and comes and visits. So, um, but if somebody is actively concealing something, for example, they check no, they tell you no to a diabetes question. And again, there's all this diabetes equipment that's there. If it's true that they are diabetic, if it's true that they're smokers and they're withholding that information, that's called concealment. Now, fraud is, concealment is a kind of fraud, right? Fraud has a little bit deeper meaning here, though, because it means you're intentionally misrepresenting or concealing. But there's this concept of material fact, and you're determined to try and, cheat the insurance company. Usually, that's what that means. It's usually the person. Insurance companies can't really, generally, aren't the ones committing fraud. I'll say generally. So mostly it's, a person applying who's trying to misrepresent something on purpose. Now, in quotes here, you see material, concealment of a material fact. What does material mean? It means relevant to the decision to enter the contract. Kind of, you can sum it up from the standpoint, again, if you put your insurance company hat on and you think, if I'd known that, I wouldn't insure you, that means it's material, right? And smoking, might be an example of that. Usually, really in life insurance contracts, what happens with smoking is it's you have to pay a higher premium, right? So it might not be a deal breaker, but if the person's trying to, you know, um, misrepresent that so they don't have to pay the higher premium, that's obviously not something the insurance company wants to deal with. But there can be other, bigger things like you conceal the fact that you're actually a motorcycle racer and, you're writing this life insurance policy and kind of representing yourself like, no, I just do this desk job. And the insurance company thinks, if I'd known that you were a motorcycle racer, I wouldn't have written this $500,000 life policy on you, So material, it means it has a big impact on the decision. And fraud is when people intentionally misrepresent those material things, those important things uh, in the contract. All right, next one is reasonable expectations. The insured is covered by a policy in a way that any reasonable person would expect. So this is a way of sort of covering the fact that you can't write down everything in any contract, and this is kind of protection for the insured. Again, remember we talked about it's a unilateral contract, meaning that the insurance company wrote it. If there's something that's not clear or confusing, and the insured says, this is the way I understood how I was covered, and it's reasonable, then the law is going to kind of favor them in that respect. So this is reasonable expectation simply means that, you know, if any reasonable person would expect, like a life insurance policy, it's going to cover them in the case of death. That's pretty reasonable, right? And maybe there's like some confusing exception in there the person didn't understand very well. The law is going to, be in their favor because it was reasonable for them expect to be covered for a natural death, for example. So, again, from a contract standpoint, reasonable expectations uh, covers, it's sort of a protection for the insured. All right, here's a concept that, again, you need to know. It's called fiduciary responsibility. Again, talking about using, big terminology for pretty simple concepts. It simply means being responsible with money. As an agent, you're going to handle money. Most, if you're doing life insurance for sure, you're going to be handling money in those insurance transactions. You've got to do so in an honest, responsible way. One example you could think of here, with fiduciary responsibility. Let's say a applicant gives you that premium check and you lose the check. It gets lost in your car, falls out of your portfolio, goes underneath your seat, and you don't do anything about it, or you forget about it. It never gets to the insurance company. Well, you've obviously not kept up your fiduciary responsibility. The applicant gave you money. You're a representative of the insurance company that you're working, writing policies for. So in that respect, it's your responsibility to make sure those transactions go through, right? That's what agent means. You're a part of that process, and that's part of your responsibility. So fiduciary responsibility simply means, responsible with money. Waiver is another important concept. It means giving up a right. You waive your right. So here's an example. The insurer has a right to collect medical information, for example, but they issue a policy without doing a medical exam. So, and some policies will do that. So then they find out later that, oh, wait a minute, you actually had cancer, right? But by signing you up or issuing the policy without the medical exam, by doing that, they've waived their right. So they can't ask the insurer later to do an exam. They can't say, hey, wait a minute, we think, you might have cancer. I want you to do an exam now. They can't. They waive that right when they issued the policy based on the information that they have. So that's waiver. Now, Estoppel, I always think of this, it's just like a very German sort of word, right? Estoppel. So it literally means stop. I think it is German, actually. It means literally stop. And it legally stops one party of the contract from reclaiming a right that was waived. So in the example that I said before, if the insurance company um, sued and said, wait a minute, I wanted to find out if this person had cancer and they wouldn't let me, they would lose, right? Because of estoppel. They are legally not able to reclaim a right that they've waived. So you can't get that right back once you waived it. Now, there are other kind of waivers we'll talk about in other sessions, but for now, waiver, you're waiving a right. Estoppel means you don't get to have that right back if you've already issued a policy. All right, here's another term that we don't use this language too much. Parole. We usually talk about parole from the standpoint of jail terms, but here the parole evidence rule. Actually, parole here just means oral, and the parole evidence rule prevents oral or other evidence from being used that's outside a written contract. So insurance contracts are written contracts. Um, they can't come in later and be modified, by somebody saying, well, I think this is what that meant, or providing oral evidence, or maybe they hear a story about a person. That can't be brought in later to change the contract. So the contract is written, it is as it stands, and that's what parole evidence rule means. Here again is another term that's not our usual, use or English language. So you got to kind of put it in your head or write it down, learn. Each one of these terms is something that you're going to learn. Um, and insurance concepts are like that. You just have to, get them down. Once you get them down, they'll stick, and you'll be able to recognize them on the exam. I promise that later on people don't talk too much or use this language too much. Subrogation is something, though, that does come up. It means to substitute. And very simply put, the insurer has a right to pursue compensation from a third party that caused a loss, and then substitute their loss with money from the third party. What does that mean? Let's give an example of that. It's easiest to think about this in terms of property insurance, like auto, car insurance. Uh, let's say, for example, you have a car accident and the person, not you, the insured, but the other driver was the person that's at fault. So the insurance company has to, cover your losses, but they have the right to go after that other person or even the other person's insurance company to recoup what they've paid, right? Which makes sense. It wasn't, there was somebody else who was at fault. So the insurance company has a right to go after them legally to recoup some of those losses that they had to cover. So that's subrogation. And subrogate again means to substitute. Substitute, your loss with somebody else's in this case. Last, we're going to cover insurance agent authority, and that will be it for this video. And there's a lot of threes and fours here. Three types of agent authority. First one is express authority. So you as an agent for a company have explicit written authority that's part of your contract with whatever insurance companies you represent. So for example, almost every contract that you make with an insurance company gives you the right to collect premiums and applications, and there'll be some kind of clause in that contract that's express. Express means a written down authority. It's clearly in black and white in your contract with your insurer. Number two is implied authority. Again, this refers to your relationship with the insurer, either you as an agent working with on behalf of the insurer. And they give you an authority. It's not written down in your contract with them, but to fulfill certain duties as an agent. Obviously, you're going to be able to write policies, go and set appointments. Not every single one of those things is going to be lined out in your contract with the insurance company. So it's going to be, though, an implied kind of authority that you have as an agent to, for example, help somebody find a policy that works for them, right? So last one is apparent authority. Now, this has more to do with your client and you. And it does have to do with your relationship with the insurance company as well, but it's mostly about the customer's perception of your authority. Now, the insurance company gives you certain, branded information, branded material. Maybe you have you might have a pen, you might have a pen, your name on letterhead, uh, whatever. The sort of you have material that's from that branded insurance company. So is the apparent authority is the customer's perception that you're part of that insurance company. It's a good thing, right? It's nothing wrong with that. But just understand apparent authority means the customer's perception. You have authority based on material that you have that's branded, and the fact that you showed up, at their door representing a company, writing a policy for a company. So going back to sort of that fiduciary responsibility, they might have, part of apparent authority is, I can give you this check. And that's like giving the check to the insurance company. So that's apparent authority. All right, there we have it. We've gotten through all of our general insurance concepts. Might seem like a lot. We spent an hour together. And after you've reviewed and gone through those, I'm confident you can get them firmly planted in your mind so that you do great when you see these come up on your insurance exam. So again, I'm Chris, your insurance exam guide. Thanks for spending time here today. See you in the next video.